Greetings, members, one and all of the Salivation Nation. Silver and gold await the Fed. Let's explore. Indeed, the market had some turbulence today, and gold and silver kind of just lingering around there. Another day of a little bit of opposite poles for both gold and silver. In fact, the gold to silver ratio seems to want to widen a bit more now, back to where it was before, back over 77 to 1, as gold is trading now up $4 and silver is still down 17 cents. Movement, but not too bad of a drop for silver, and not too much of an increase for gold there as we check into the markets here. But the Dow Jones had a pretty rocky day. This morning I did a video during this big drop, pretty much right at the bottom of the drop. It's been choppy ever since, and then late in the afternoon the Dow Jones picked up pretty to bring its head above water again. And now we are seeing it come to a close here for the markets, down about 67 points. So there is a pause for gold and silver as we reference two articles here from Kitco, from Jim Wyckoff. Gold and silver futures prices are trading not far from unchanged in early U.S. trading Tuesday, just ahead of a key U.S. Federal Reserve meeting. It's still a general risk-off trading mentality in the marketplace early this week, and that's limiting selling interest in the safe haven metals market. February gold futures were last down at 1841.10, and March COMEX silver was last down about 2 cents at $23.77 an ounce. The U.S. data point of the week will be the Federal Reserve's Open Market Committee meeting that begins Tuesday morning and ends Wednesday afternoon. So we're about halfway through the meeting schedule there, with a statement press conference from Fed Chairman Jerome Powell. It's expected the Fed will raise U.S. interest rates at its March FOMC meeting. I made a prediction earlier today that I think they may actually either make that firm announcement that it will be happening, or maybe even act soon, like right now, and raise a rate 1/4 point now. But, I don't know. We'll see, because of the volatility of the stock market. Now, who knows what tomorrow will bring? The marketplace appears to be getting more anxious regarding how the Fed is going to deal with rising and even problematic price inflation. Most believe at this FOMC meeting that the Fed and Chairman Powell will better lay the groundwork for 4 U.S. interest rate increases this year. They might do it sooner rather than later. Global stock markets were mixed overnight, with Asian shares mostly down and European shares mostly up. U.S. stock indexes are pointed towards lower openings when the New York day session begins. The major U.S. indexes hits 7-month lows on Monday. Serious near-term technical damage has been inflicted upon the U.S. stock indexes to suggest that they have put in near-term market tops. Big rebounds from Monday's strong losses in the U.S. indexes and the closes near the daily highs does suggest the stock market bears are now exhausted. So we'll see. That's a positive spin on it. We'll see. What will the Fed do? All eyes are on the Fed. In this article here from Anna Golubova from Kitco as well, can it soothe the markets? And here's what she's expecting here. After a few wild trading days of stocks and crypto sell-offs, contrasted by solid gold prices, markets have zeroed in on the Federal Reserve's meeting this Wednesday. But can the U.S. Central Bank provide any relief in light of all the hawkish expectations? There are some analysts that have weighed in here. It's widely expected that the Fed will keep its monetary policy on hold during the January meeting. But this time around, it's all about what to expect in March. So I'm going against the conventional wisdom and thinking they're going to raise it 1/4 point, and they'll announce it tomorrow, or actually Thursday or Friday. But I may be way off. I might be the only one saying or making that prediction, but I think because of the last couple of days in the stock market, that may push them to go ahead and raise it a quarter point now and to pleasantly surprise the markets. And we'll see, though. If they were to do that, I believe you might see the stock market go up and have a little bit of a boom and gold and silver to fall because it would be an unexpected surprise. And so many market observers have suggested that the Fed is unlikely to walk back its hawkish promises of wrapping up tapering sooner than expected, introducing at least 3 rate hikes this year and looking at balance sheet runoff after completing tapering. The focus on this week's FOMC meeting and a growing cohort of participants hoping that the Fed will manage to provide a soothing tone for markets, considering that Chairman Powell's primary goal is to prevent a de-anchoring of inflation expectations. It's unlikely that the Fed will pivot from their plan to start hiking rates as soon as March and start quantitative tightening soon after, said strategist at TD Securities. The reason for a much more aggressive Federal Reserve in 2022 is the 4-decade high inflation numbers and rising wage pressures. And this situation is not about to change, said PBH Global Currency Strategy head Win Thin. A hawkish hold is widely expected as the Fed sets the market up for a liftoff in the next meeting, which is March 15th and 16th. A hike then is fully priced in, as there are 3 more hikes in each subsequent quarter this year, said Thin. We expect Chair Powell to send a very clear signal. Markets will be keen to see any clues on how soon the Fed will allow balance sheet runoff. We had thought this would be a 2023 story, but given recent official comments and accelerated timeline, we believe runoff will begin in the 3rd quarter. And you think about it, if they do it, especially if they do it now, that will be a pleasant surprise because, like I said, all this stuff is already baked in. And look what the stock market did the last couple of days. It's been all over the place. The Fed's number one priority remains to get inflation under control as the U.S. economy moves closer and closer to full employment. The Fed simply cannot target the equity market as well. Yes, financial stability is the Fed's implicit 3rd target, but not every correction or bear market results in financial instability, especially as the U.S. economy is well on its way to recovering from the pandemic, Then pointed out. Well, I don't know, these last 2 days may be testing that theory. Markets have been preparing for a March rate hike for a while, but what could catch a lot off guard is a 50 basis point hike in March and a sooner than expected balance sheet runoff. And I think it's going to be a quarter point now and then another quarter point in March. But we'll see if I'm right. I'm likely going to be wrong on it. It's just a hunch in my view. A likely hike in the funds rate in March has been well communicated, so a prepare for liftoff signal should not surprise anyone. More important for markets will be the guidance on the likely pace of tightening via quantitative tightening, QT, as well as the funds rate in the years ahead. And strategists at TD Securities, we don't expect definitive signals, unfortunately, and the result could be a mixed message. TD Securities added that a 50 basis point increase would be very likely in March. We see virtually no chance of the Fed officials starting the tightening cycle with an increase that large. The last 50 basis point increase in the funds rate was at the end of the 1999 to 2000 tightening cycle when Alan Greenspan was chair. Fed officials are likely to step up the frequency of rate hikes and the scale of quantitative tightening before the resort to rate hikes exceeding 25 basis points, the strategist explained. We'll see if I'm right at the end of this week that I don't think they're going to do that either. No one is talking about what they might do at this meeting. They may actually go ahead and tighten a quarter point or raise it a quarter point now and then another quarter point in March. Boy, wouldn't that be something if they did that. Looking at equity markets, analysts say it's too early to say whether or not the sell-off is over. On Tuesday, U.S. equities were on another wild ride, first dropping and then attempting to recover in the afternoon session. We covered it here almost live on this channel. At the time of the writing, the Dow Jones Industrial Average was down about 2%, and the S&P fell 0.8%, and NASDAQ Composite dropped 1.6%. It's way too early to sound the all clear. The same factors that triggered the bout of risk-off sentiment, hawkish Fed, weak economic data, and earnings and Russia tensions with Ukraine have not gone away yet. While price swings in the market will continue until uncertainty around the Fed tightening cycle and increased geopolitical tensions are somewhat alleviated, said FXTM senior research analyst Lukman Otunuga. U.S. equity bulls are certainly not out of the woods. Should inflation concerns, Fed hike fears, and geopolitical tensions fuel risk aversion in the days ahead, this could spell trouble for risk assets across the globe, Otunuga said. While the Fed may stick to the script, any hesitancy on future rate increases or a more dovish tone could breathe life back into riskier assets. Alternately, a hawkish Fed may deal another blow to stock market, injecting equity bears with fresh resistance. That's interesting. I kind of look at it the opposite way, because they like to see, this means that it's a move to hopefully preserving and stabilizing the markets, and they would react positively to that, at least at this point, maybe in March, or even especially if they're to do it early, a quarter point to this week. In the meantime, the crypto market has been closely following the heavy tech stocks sell-off this past week, and Bitcoin managed to recover above 37,000 and was trading flat on the day, and Ethereum was up at $2,506. The key moment for Bitcoin, and if panic selling occurs on Wall Street, the $30,000 level may not prove very supportive. A period of calm should enter as financial markets await the Fed, but that might not be the case given January's volatility, said Oanda senior market analyst Edward Moya. Gold had another stellar session, rising above a key $1,850 an ounce resistance level as a general risk-off trading mentality in the marketplace earlier this week, and that's prompting buying interest to the safe haven metals. And indeed, that's just it. Gold, even though it's up slightly here, it is getting close to that 1850 period. It's holding on here. And silver really is doing not as bad as some people expected either, although it is down a little bit. But I think that's because of it as a commodity. It's seen as a commodity. So this is a part of the reason why you do see the separation here. Gold is treasured, silver is consumed as a commodity, and that's the key difference why some of that price differential may be there. Gold kicked off the week on a firm note as tensions accelerated the flight to safety with Russia. There's no doubt that this will be a big week for gold, with its near-term outlook likely to be influenced by the Fed meeting. A hawkish Fed that signals multiple rate hikes could dampen the appetite for gold, resulting in prices sinking back towards 1831 and 1810. If the Fed surprises markets by deviating from the script and shows hesitancy in future rate hikes, this may push the precious metals higher towards 1870. Yes, and I don't think that's going to happen. I think they may. I'm predicting. We'll see if it happens or not. I may be completely way off here, but why not? I've been wrong before. I may as well go on a limb and be wrong again, but I think they may signal to go ahead and do that hike now. But we'll see. In other words, this week. So there you have it. There's where the markets are. The Dow Jones Industrial Average down a little bit today, but not as down as it was earlier. There you have it. Let me know what your thoughts are in the comment section below. We'd like to extend a multitude of gratitude to you all for taking the time to watch, and to encourage you to please rate, share, comment, and subscribe.